Good day, everyone. Trust you're doing well today. Today, we're talking about why AI stocks are crashing and if investors should be worried. Have you noticed something strange lately? The same AI companies that everyone was celebrating a few months ago are suddenly getting punished by the market. Stocks like Nvidia, Broadcom, and other AI related companies have been under pressure again. And naturally, many investors are asking the same question, which is if AI is supposed to be the future, why are AI stocks falling? Now, at a glance, that looks confusing. AI is everywhere. Companies are spending billions on AI. Governments are invested in AI. Every week, there seems to be a new breakthrough or upgrade in AI. So, why then are investors selling? Well, after digging into what is happening, I think most people are asking the wrong question. The real question is not, is AI a real thing? Rather, the real question should be, who is actually going to make money from AI and when? And that is where things really get interesting because what we are seeing right now is not really a technology story. It's a game. It's a very expensive game involving some of the biggest companies and investors in the world. Let me break it down. Imagine there is a gold rush. Some people are actually digging for gold. Some people are selling shovels. And some people are investing in the miners. While some people are standing on the sidelines trying to figure out who is going to win. That is basically today's AI market. On one side, you have companies like Nvidia and Broadcom. These companies are selling the tools that power AI, which is the chip, the networking equipment, the infrastructure. These guys are the shovel sellers. Then you have companies like Microsoft, Google, Amazon, Meta, OpenAI, and Anthropic. These companies are spending enormous amount of money buying AI infrastructure. They are building data centers, training models, hiring engineers, trying to become leaders in the next generation of technology. And then you have investors, the people who are funding all of this. And right now, investors are starting to become impatient because for nearly 2 years, the market operated under a very simple idea. AI is the future. Buy everything AI. That was enough. But now it turns out that the market wants something more. Now investors are saying, okay, if we believe AI is the future, but where are the profits? That simple thinking, that shift of mindset is what is driving much of the volatility we are seeing today. Now, one of the biggest example recently was Broadcom. Now, Broadcom didn't report a disaster in their company. No, far from it. In fact, the company still showed strong AI growth. Demand is still there. Customers are spending, but investors had become used to something very dangerous. They had become used to perfection. They wanted Broadcom to raise forecasts aggressively. They wanted another huge surprise. They wanted proof that AI growth was accelerating even faster. Instead, they got something that was merely very good. And in today's market, very good is something not enough. Think about it this way. Imagine a football player scores 50 goals in a season. The next season, fans expect around 60 goals. Now, if he scores 55, that's still incredible, right? But then again, expectations were around 60. Somehow, some people will end up being disappointed. Now, that's exactly what happened. The stock market isn't comparing companies to reality. The stock market is comparing reality to expectations, and expectations had become extremely high. This brings us to what I think is the most important part of this story, valuation. Now, don't worry, this actually sounds, complicated, but trust me, it's very simple. Valuation is basically you asking how much are investors willing to pay today for the future profits. And that's where things became really stretched. Many AI stocks doubled, some tripled, some went even higher. As prices kept rising, investors started pricing in years and years of future success. At some point, the market starts asking a very uncomfortable question. What if things go well, but not perfectly? And when stocks are priced for perfection, even small disappointments can trigger big declines. That doesn't mean the business is broken. It just means rational thinking by investors, got ahead of reality. Now, there's another player in this whole situation that doesn't get enough attention. That's the Federal Reserve. The Federal Reserve isn't, focused on AI. The Fed is actually focused on inflation and the economy. Now, when I say the Fed, right, I mean the Federal Reserve, which is, the US Federal Reserve, which is similar to the Central Bank of Nigeria. But, the US Federal Reserve decision actually affects AI stocks more than many people realize. Here's why. Most growth stocks are valued based on profit expected years into the future. Now, when interest rates stay high, those future profits becomes, less valuable in today's dollar. So even if AI companies continue growing, higher, interest rates, by the Fed can still put pressure on AI stock prices. That's one reason why strong economic data can sometimes be bad news for technology stocks. A stronger economy may mean rates stay higher for longer, and that changes how investors value future growth. Now let's talk about Nvidia, because Nvidia is still at the center of all this entire AI story. Almost every major AI company depends on Nvidia technology. Companies like Microsoft, Google, Amazon, Meta, OpenAI, the list goes on. Demand for computing power remains enormous. That hasn't changed at all. But investors are wrestling with a difficult question. Has Nvidia become too successful? Not the Nvidia business itself, it's the stock. Now, there is a difference. The company can continue growing while the stock struggle if expectation got too high. That's why what we are saying today looks more like a valuation debate than a business collapse. The business is still strong. The market is only debating how much that strength is worth. Microsoft is in a slightly different position, and honestly, that's why many investors see Microsoft as one of the safer ways to play AI. Microsoft isn't depending entirely on AI. It already has huge businesses. Think of Windows, Office, Azure, LinkedIn, Xbox. The company is already making massive profits. AI is being added on top of that foundation. But even Microsoft faces the same challenge. Investors want proof. The company is spending enormous amount on AI infrastructure. Eventually, some investors want to see that spending turns into meaningful earning growth. And that's really the theme of the entire market right now. It's some people demanding for proof, not, promises, not some type of future potential talk. They just want solid proof in terms of earnings right now. Now, this leads us to the question everyone is asking. Is this another dot-com bubble? The answer is both yes and no. Yes, because there are similarities, excitement, speculation, fear of missing out, which is, FOMO, huge stocks gain. We have seen all that before, but there is also a major difference. Many dot-com, companies had little revenue and almost no profit. Today, AI leaders are completely different. Companies like Microsoft, Nvidia, Amazon, Google, and Broadcom are already generating enormous amounts of revenue. These are real businesses, real cash flow, real customers. Personally, I think the better comparison isn't the collapse of the internet. It's the growing pains of a revolutionary technology. The internet didn't disappear after the dot-com bubble. In fact, it became even stronger, advanced. The winners simply becomes clearer over time. And I think that's the complexity investors are trying to solve right now. Not whether AI survives, but who wins. Now, looking ahead, I think there are three possible paths. The first and most likely outcome is that AI continues growing while investors become more selective. The strongest companies keep winning, the weaker companies struggle. That would actually be a healthy outcome. The second possibility is that the economy slows, corporate spending cools down, and AI stocks experience a deeper correction before recovering later. The third possibility is the most bullish, which is AI adoption accelerates faster than expected. Then companies will start showing massive profit growth directly linked to AI. And today's sell-off ends up looking like a temporary pause before another major AI rally. Personally, I think the first scenario is the most likely, and here is why. The evidence today doesn't suggest AI demand is collapsing. What it suggests is that AI are becoming more demanding. That's an important difference. The market is no longer paying, simply for AI excitement. The market wants AI earnings. And in the long run, that's actually a good thing because eventually every investor story comes down to one thing. Can this company make money? Not headlines, not promises, because most people don't even know how to stick to or conceive the idea of waiting for future promises. Then lastly, money, which is profit. Now that's the stage of the AI boom we are entering now. The easy money phase may be over. The proof phase has just begun. And that debate is still ongoing within investors, that's AI investors. And that's why it's playing out in the stocks right now. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.